We are now joined by Mr. Dhirendra Swarup, member and convener of FLRC, and along with him Ajay Shah, senior fellow with NIPFP. Dhirendra, let me kickstart the discussion with you. Dhirendra, if I look at your report, you have rewritten a large number of financial sector laws into the draft financial code. What are the key highlights of the new code?
Well, I think, as you might know, that this is for the first time in the history of independent India that such a holistic exercise about the entire financial sector is taking place. And so obviously we had to look at all the financial sector legislations which were established, had been set up since more than 100 years. So the main outcome, to answer your question directly now, the main outcome of our entire exercise is that more important financial legislations have now been integrated into one code, which we have titled the Indian Financial Code. And that financial code, the emphasis is on 3 or 4 main areas, and they are consumer protection, the macroprudential regulations, and resolution mechanism of failing firms. So I would say that the main outcome is conversion of all the important financial legislations into one law known as the Indian Financial Code.
Ajay, the FSLRC recommends merging 4 regulators into a unified regulatory authority. What was the rationale? And do you think in evolving financial markets, a single entity can regulate diverse segments of financial markets? And what about really the accountability too?
Okay, so I would like to respond in 2 parts. The first is that in recent years, we have seen how there are many parts of the finance business where actually the division between sectors is not at all tidy. What is a mutual fund? What is an insurance company? What is a money market mutual fund? These lines are actually much more subtle than we think. And anytime you have 2 separate agencies, there is going to be a certain inconsistency of treatment. There will be some things that will fall between the cracks. With the inconsistency in treatment, what will happen is that the financial firms will always like to find the weakest regulatory framework and put more of their business there. As an example, we saw how insurance companies were portraying fund management activities because at that time the regulatory framework in IRDA was weaker. These kinds of problems are going to multiply and worsen in the years to come because finance is very clever. There will be lots of innovation, there will be many new things that will come, and they will just further blur the lines. So that is why it is important to write non-sectoral laws and implement them in a wide manner rather than trying to create little vertical silos. So that was the thought process in the FSLRC, which thought that we should break up the work of financial regulation between 2 agencies, where RBI would do banking and payments, and a second agency would do everything else.
Ajay, but just to take that point forward, some experts also believe that merging regulators and allowing by a larger role by the government could take away the autonomy and independence of regulators. How do you think that problem could be solved?
Okay, so first there are 2 completely different questions. Do you want a merger between SEBI and FMC? And do you want independence accountability? They can be completely different. It is possible to have a SEBI standalone which has independence accountability. It is possible to have a SEBI FMC merged which has no independence, no accountability. So let's not mix up those questions. FSLRC has walked a great deal of a distance on getting the right package of independence and accountability. In the present Indian system, we have neither accountability nor independence. So when you look carefully at the draft Indian Financial Code, the Commission has put in enormous effort on enshrining independence into the law and on achieving many pathways to accountability. We have a completely different approach, and when you compare against the way things were done in India, which is really reflecting legislations of many decades ago, against what is embedded in the draft code, you will see lots of state-of-the-art ideas have been imported by the Commission to put into the code on independence and accountability.
Dhiren, you've suggested repealing LIC and SBI Acts. What really is the rationale behind this? Would it be level playing field?
Well, you have answered the question yourself by asking me a question that does it create a level playing field? Yes, that is precisely the reason why we have suggested to the government that all special legislation setting up financial corporate bodies like the LIC and the SBI should be repealed and they be converted into normal companies. Now, we are not commenting on the ownership of these companies. The owners will continue to be the Government of India, both in the case of SBI and the LIC. But we want a level playing field for the depositors and the policy holders. Today, for instance, in the LIC, there are different investment norms which apply vis-a-vis the private insurance companies which are governed by the IRD investment norms. So we thought that it's in the interest of the policyholder and the interest of the depositor that they can be converted into normal companies under the Companies Act for purposes of regulation.
Dhirendra, if I look at the key highlights of the code, you have retained Reserve Bank of India as a regulator for banking, but you have modified the scope. Though you have kept its role pertaining to the monetary policy, however, you have suggested the creation of a separate debt management office. Why is that?
Well, debt management office, to be frank, is not an idea which really is Commission's idea. We don't want to take the credit for that idea, because this has been on the anvil, as you're aware, for about a decade now. And government had almost taken the view in principle that they will take away the debt management function from the RBI. RBI is, strictly speaking, not opposed to the idea or the concept as such. They are only saying this is not the opportune time, not the right time to do it. When the fiscal deficit is running high, and then we need to borrow from the market on behalf of the government. So we feel that no opportune time or right time will come at all. So the government must now take away the DMO, because in the view of the Commission, there is, and everyone I think agrees, there is an element of conflict of interest between the monetary policy function and the debt management function.
Ajay, on capital controls, while you have made the Finance Ministry responsible for making rules for inflows, RBI has been given the task to make rules for outbound capital. Also, you've given RBI the sole responsibility to implement capital controls. What was the thinking behind this move?
On the implementation of capital controls, in many ways, what is being done is similar to the present arrangement. The system of authorized dealers, who are largely banks, will work with the RBI, and that is where capital controls will be implemented. When you come to the rule-making function, in the case of government it's called a rule, and in the case of RBI it's called a regulation. When you come to the rule-making function, particularly in the case of inflows, there are many political choices. It's actually a political choice about whether you want to have FDI in retail or not. It's actually a political choice about whether you want to open up to debt flows for infrastructure or not. So the argument was that on the inflows there is a much bigger and legitimate role for a political decision by the government. To take you back, remember when we did trade liberalization, the decisions about whether India should have free imports of steel or not is largely a political decision. It's not an economic decision. And it is appropriate that these political choices should be vested with a political authority. In the case of outflows, there is none of this politics, and then it can be viewed as a part of the larger macroeconomic policy framework of the country, and that is why this is kept at RBI.
Right, Dhirendra, what are the issues that you believe could hurt or really have impeded the transaction of this regulatory structure? What timelines do you believe that this can come into effect now?
Well, timelines, to be frank, is not, the ball is in the court of the government, and as I mentioned, that it's a major exercise, and the recommendations are far-reaching. So we are not hoping that it will be done overnight. So, and there is a legislative process to go through. So it could take anywhere between 6 months to 2 years. So it all depends on the will and determination of the government. And if government wants it, it can be done quickly. but then there are constraints about the parliament sessions, etc. So, but the first thing is for government to examine, analyze and accept the recommendations, and remaining will follow in due course.
Right. Ajay, on capital controls, are you taking away the powers of other agencies like DIPP and ED to monitor and regulate flows?
Yeah, there's a big streamlining of the arrangement. RBI will dominate in terms of the implementation and the investigative process when it comes to capital controls.
Now, Dhirendra, you have set up a resolution authority for failing companies. Will it be able to avoid instances of companies going bust?
Well, we are looking to avoid knee-jerk reactions to firms that fail. Now, you might be aware, several financial institutions which failed, and overnight either those banks were merged with some other bank, stronger banks, and so though we want that all financial institutions should be monitored from time to time by an organization known as by the Resolution Corporation, which will keep an eye on the financial health from time to time and take remedial measures if they find that they have symptoms of weakness. So we are not saying that we want to avoid firms to fail. No, we are only saying that we will resolve the issues in time, and instead of having a knee-jerk reaction to such institutions.
Ajay, the report also recommends a new public debt management agency, basically a debt management office for the government. How will this help?
I thought we just went through it. As Mr. Swarup emphasized, for more than a decade, this has been the thinking of policymakers, that it is really awkward to place the investment banking function for the government with the central bank. If the central bank cuts rates, that makes financing for the government cheaper, and that should not be a consideration on the mind of the central bank. The central bank should do monetary policy only with regard to macroeconomic policy objectives such as price stability. So what the PDMA will be is a separate agency that will serve the government of India in doing its investment banking work. It will be two improvements when compared with the present arrangements. The first is RBI will no longer be burdened with the objective of meeting the financing requirements of the government. The second is that it will be the first time that a comprehensive look of all aspects of government debt financing and other contingent liabilities will come together in one agency. At present, this information and the work is scattered between Ministry of Finance, RBI, and nobody actually has the full picture.
So, Ajay, what exactly are the global best practices?
All over the world, this is the way it is done, that the central bank does not do issuance for the government. I believe there is only one country that I can think of, Denmark, where the central bank does issuance of government bonds. Other than that, everywhere in the world, either it is done within the Ministry of Finance or it is done by a body like the PDMA that has been recommended by the Commission.
Okay, Ajay as well as Dhirendra, good to have you guys on board with us. Appreciate you really taking the time out and chatting with us this morning.